Recently, there has been a lot of discussion about the possibility of gold and silver breaking once more, as if the most recent whipsaw motion signals that the paper markets are ready to collapse. We will so distinguish between what is truly important and what is merely noisy in this movie. Additionally, you'll leave feeling much more composed and knowledgeable about what you're witnessing, because you've most likely seen some variation of this assertion if you've been on social media this week. Silver is slammed, China goes out, the Western markets take control, and then a huge stack of futures contracts will demand metal that the system does not have. It sounds awful. It has a clear sound. It spreads precisely because it sounds like a math problem. February 18th, Wednesday, New York time. I always enjoy seeing where everyone is and how much ahead or behind you are, so before we continue, please leave the day and date you're watching from. Just a short reminder. If you appreciate this type of analysis, please subscribe to the channel and leave a comment for future Ledger Anna. It really helps, especially when the algorithms start acting strangely. Here's what's really going on now. It has been ripping higher, slamming lower, and then ripping again for gold and silver. These markets are in a stage where little positioning changes can result in significant swings, not because the world abruptly changed every 8 hours. Indeed, that encompasses actions that seem intimate when you're mining stocks, holding metal, or even just staring at your screen as if it were a heart monitor. We can't pretend it doesn't exist, so let's start with the obvious. Silver is no longer in the drowsy normal range. Not very long ago, it was in its top 20s, but it suddenly began acting as though it had an important place to be. Furthermore, it recently entered pricing region that compelled dealers, hedgers, and the exchanges themselves to do something. And it matters when the exchange responds because one of the most significant developments that actually occurred silently, mechanically, and without any dramatic music was the raising of margin on important transactions involving precious metals during a surge in volatility. Furthermore, you don't need a conspiracy theory to explain why prices can drop quickly when margins are raised. Leverage, math, and individuals being compelled to lower risk are all you need. Now, a brief note about margin that explains a lot but is hardly discussed. The way you own a share of stock is different from how many traders actually own a futures contract. They are using a performance bond to rent exposure. Additionally, their position size essentially grows too large overnight when that bond is raised. The rules changed, and they now have to post more money or lose their job even though they didn't do anything different. A chain reaction results from that. People who alter their minds aren't necessarily the first to sell. They are sometimes the ones who have run out of space. Occasionally, they are the ones whose broker increased danger. Sometimes a client's dashboard unexpectedly turns red after the fund promised them low volatility. You can get a drop that appears to be broken when it's actually just a leveraged throng trying to squeeze through a doorway at the same time, when that forced selling occurs at a thin moment, such as a holiday week, a weekend reopen, or a session where liquidity is simply less than usual. The cliffhanger is about to happen. Who was forced out will determine what occurs once that entryway clears. Was it strong long-term conviction that was being shaken, or was it poor short-term leverage? Because the market frequently stabilizes more quickly than people anticipate if it was primarily leverage. You can observe persistent follow-through selling if there was conviction. Thus, we require a means of distinguishing between the two, and that's where the data, the dull stuff, comes in handy. You may determine whether open interest is decreasing, whether volume is exploding, whether spreads are widening, and whether physical indications deviate from the paper price based on previously released market updates. These are the indicators that distinguish genuine trend shift from forced cleanup. Well, that's important for the next section, so keep it in your pocket. Yes, and I will also show you what I'm watching next. This is the bit that most people overlook, though. A strong run followed by a sharp drop is not always a sign of bearishness. Yes, it can occasionally be the top. It can occasionally be the start of the end. However, it's also how the market purges itself in markets like silver. It's how stronger hands take the place of weaker ones. It's how bets that are too leveraged are cut down so that the next leg may proceed without the entire structure collapsing. Imagine it as a packed theater. Even though everyone is anticipating the same film, it may still be an excellent film. However, chaos results when too many individuals attempt to cram themselves into one row at once. The crowd is poorly handled, not because the film is horrible. The shove appears to be a crash, and a margin hike is just the usher stating, "Some of you are going to have to move." The competing narrative now attempts to make this seem like a single, straightforward tale. The slam-on occurs when China shuts down and Western price discovery takes control. I understand why that is gratifying. It's tidy. There is only one lever. But things are messier in real life. Indeed, when key markets are closed, liquidity changes. Price discovery does indeed become focused. Indeed, in the absence of depth, larger intraday fluctuations are visible. However, it's not simply about authority. Additionally, it concerns who is underhedged, overexposed, and who has received a margin call at the worst possible time. This leads us to the volatility indicator that is constantly being mentioned. The existence of volatility indexes is justified. When traders anticipate significant changes up or down, options indicated volatility for silver might spike. They are essentially the market acknowledging, we don't know what's going to happen next, but we're paying up to insure against it. And that expectation has increased recently. Does high implied volatility, however, indicate that the rise is still going strong? No, it demonstrates that the market believes a violent next move is possible. That's all. According to the weather forecast, a storm is possible. Whether the storm is coming from the east or the west is not indicated by it. It simply warns you not to go outside while feigning a serene spring day. Therefore, if you are utilizing a silver volatility metric as a one-way bullish signal, you are doing the same thing that individuals do during hurricane season when they believe that a certain street will flood because of wind speed. Perhaps, perhaps not. Let's now discuss the COMEX delivery drama, which is the second major pillar in the competing storyline. What you'll hear is this. Open interest amounts to a few 100 million ounces. However, the number of registered ounces is limited. Therefore, the exchange cannot deliver if everyone stands for delivery. The game is over. Well, that makes sense. Additionally, it's the quickest way to misinterpret the true operation of futures markets. Because there aren't a lot of folks who want to come on the same day and take bars home that make up open interest. A list of open contracts is called open interest. Hedges are among them. Spreads are among them. A few are rolling. Tomorrow, some will be closed. Some are held by individuals who have no intention of ever coming into contact with actual metal. This analogy is superior to the one you typically hear. Consider a hotel in a crowded metropolis. All of the reservations that are currently on the books are comparable to open interest. However, those reservations include those made by those who will cancel, change their dates, transfer rooms, or fail to show up, as well as those who reserved 3 rooms because they were unsure which one they wanted. Every reservation doesn't have to result in someone requesting a key at the same precise moment for the hotel. The flow must be controllable. Does delivery matter now? Of course, due to the fact that delivery activities can indicate systemic stress. When people favor metal over cash, it might be evident. When incentives change, it may manifest. When the paper side of the market becomes uneasy, it may manifest. Here's the important thing, though. A pile of silver is not always physically exiting the vaults, even during a busy delivery month. In futures delivery, ownership documents, rather than forklifts and trucks, transfer hands frequently. While the claim on metal changes, it might remain in the same location. There's no secret about it. The structure is that. Therefore, slow down if you're hearing that the vault is empty because deliveries are large. Next, ask a question. Are the stockpiles in warehouses changing? Is metal only being classed or is it being withdrawn? Is it blowing out spreads? Is something odd happening with leasing rates? Is this backwardation a one-day occurrence or is it ongoing? The tells are those. Not a single open interest headline. What exactly is registered silver then? Metal that has been marked as deliverable against a futures contract is said to be registered. Metal that complied with the requirements and was stored in vaults that were authorized but hadn't been committed for delivery in the same manner was eligible. And because headlines love to treat registered as if it were the entire universe, distinction is important. However, inventories can really shift between categories. Owners are able to alter their intentions. Metal can be dewarranted, rewarranted, or transferred, essentially rebranded without the bars really leaving the structure. Because of this, you may occasionally witness significant moves in categories that don't directly fit the plot of the vault is empty. Could stress still exist now? Indeed, there are a few manifestations of stress, and they're actually quite easy to comprehend. First, rather than merely switching between categories, you observe consistent, repeating drawings of the entire collection. Second, the market is paying more to obtain metal today, as evidenced by the exceptional cash premiums for immediate delivery as opposed to advanced delivery. 3. Where paper holdings are exchanged into physical settlement more aggressively than usual, you observe disturbances in regular exchange for physical flows. 4. You observe tightening collateral terms, leasing rates, and financing indications that don't correspond with calm conditions. If all factors coincide, you may legitimately declare, okay, something's different. However, if all you have is a high level of open interest, that isn't a smoking gun, it's a frighteningly large amount. And this is just one more trap. People begin to act in ways that can briefly validate the story as it becomes more widely shared. If many traders believe that delivery is the key, they might overinvest in positions that boost delivery talk, which raises volatility, generates more headlines, and attracts more attention. There is a real feedback loop. However, that doesn't mean the swap can't work. It demonstrates that people are story-driven. Watch the delivery activity then. Don't get hypnotized by delivery activity though, because the market may take advantage of you the instant you are hypnotized. Okay, we can now discuss China in a way that is truly beneficial. I'm not saying it doesn't matter, I'm telling you to watch the appropriate content. And that brings us to China, where the most intriguing tension is at the moment. This concept is heavily emphasized in the rival script. China is paying a huge premium for tangible goods, which indicates a shortage and that the boom is still going strong. Let's use caution. Yes, premiums can indicate tightness, but they can also represent contract discrepancies, taxes, delivery regulations, local finance expenses, and currency fluctuations. You risk creating a shortage narrative out of thin air if you compare two prices that aren't really comparable. Here is the other, skeptic interpretation. It's possible that structural friction, rather than just scarcity, is contributing to Chinese pricing. Even when the fundamental global balance is tight but not catastrophic, there may still be a gap due to different market mechanisms. Big, however, China has also been changing the regulations governing the export of specific metals, which is significant because it alters the global supply chain. Furthermore, the influence of stricter export licensing and regulations on the flows of refined silver has been the subject of much recent news and discussion. The peculiar silver supply is another factor that makes China significant. Most people believe that when the price of silver rises, so does its production. However, a significant portion of silver does not originate from silver mines, as most people think. It is a byproduct of other metals that are mined. This implies that the supply of silver may be obstinate. Even if no decision is made on silver specifically, silver may tighten if miners of copper or zinc slow down. Therefore, just increasing production is not a switch that can be flipped on a Monday. Then you add trading and refining. Metal must go through a series of steps, including mining, concentration, refinement, fabrication, shipping, and financing, even if it is found in the earth. And you can notice localized tightness long before the global balance sheet appears to be lacking if any link in that chain is blocked by legislation, licensing, or logistics. The discussion of export licensing is therefore more than mere trivia. It doesn't have to stop entirely to make a difference if it becomes more difficult to ship refined silver swiftly from a significant processing center. All it has to do is slow down. Furthermore, somebody who needs metal next week, not next quarter, may perceive a slowdown in an already constrained market as a scarcity. Does that mean that prices will go up now? No, since a counterforce is always present. Demand destruction, thrifting, and substitution. Engineers will put in extra effort to use less silver if its price rises to a certain point. Certain manufacturers will redesign for specific applications. There will be some delays in demand. Some will be swapped out. Here's the issue, though. It takes time for those changes to occur. Additionally, the market must still clear at a price that strikes a balance between short-term flexibility constraints and urgent demand. Therefore, is there silver on Earth? Isn't the true question. How much deliverable, purified, useful silver can arrive stress-free at the appropriate time, location, and form is the true question. And when you put it that way, the China premium discourse becomes a signal that is worth paying close attention to rather than a meme. Does that imply that China is keeping all of the silver in reserve? Not always. Global supply chains may become less adaptable as a result, though. And you don't need a cartoon villain to get price spikes and outrageous surcharges when supply chains become less flexible at the same time that industrial demand is increasing. all you require is a bottleneck. Speaking of industrial demand, this is the point at which the silver story becomes far more captivating than the typical discussion about money printing. Silver is more than just money that people keep in safes. Whether you like it or not, it's also a useful input into many of the technologies that the world is developing more of. This is another issue that has been coming up in official policy and energy discussions. The demand for electricity in the U.S. is expected to increase once more following a protracted period of relative stagnation. Additionally, data centers are frequently mentioned as a major factor in those projections. At this stage, the industrial demand story turns into a structural motif rather than a talking point. People imagine a few warehouses with blinking lights when they hear the term data centers. However, the scale we are discussing presently is distinct. Data center power demand is increasing, and this alters grid planning, as public energy authorities have been warning explicitly. Additionally, data center and AI-related electricity consumption may increase significantly over the next few years, according to international energy specialists, indicating that the build-out is not only continuing, but also increasing. Put that together with solar now. Solar is more than just a green subject. The story is about the supply chain, its factories, inverters, wiring, modifications to its transmission, and storage. Additionally, there is a lot of parallel demand for the same set of resources when the globe decides to electrify more things, including homes, cars, industries, and computers. One of the materials that frequently appears in the build-out's background is silver. Indeed, producers have been trying to lower the amount of silver in several items per unit. It's true, that's typical. When input costs increase, industry responds accordingly. However, overall demand may still increase if the production of units grows more quickly than the amount of silver being repurposed. As a result, the narrative turns into a struggle: scale versus engineering. This is the section that is often overlooked in stacker discussions. Much of the demand in industry is not speculative. It's not a decision. It is necessary for a product to function. Additionally, it operates differently than investment demand when it is a requirement. The price alone does not make it disappear. It doesn't simply go to zero. It may be relocated, optimized, or delayed. Because of this, silver may enter these stages where industrial and investment demand coincide. Because two distinct buyer categories are drawing from the same pool, price movement may occur more quickly than anticipated when that overlap occurs. Don't rely solely on the spot chart if you're looking for an easy approach to determine whether that overlap is genuine. Listen to the discussions about the real economy, industrial orders, data center layouts, and grid limitations. Frequently, the metal market responds to such events before the news media does. Why is that important to silver? Because chatbots aren't the only AI narrative. It includes hardware, backup systems, servers, cooling, power distribution, and grid modifications. And conductive metals are important in hardware. I won't sit here and say that every watt of that demand is converted into an easy-to-understand ounce count. It doesn't operate that way. However, I will say this: the demand for some resources becomes less voluntary and more inevitable as the grid becomes overloaded, manufacturing expand, and data center build-outs quicken. To get tight, silver doesn't need to be scarce. Simply said, it must be required at the wrong time and at the wrong location. This is also the point at which the meme "AI will take my job" is reversed. Indeed, AI will automate tasks. It is already. However, the underlying physical infrastructure is not free. It requires a great deal of equipment, and conductive routes are necessary for equipment. Therefore, you are overlooking the hardware layer if you are simply thinking about software while reading AI headlines. Since the competitor script accomplishes anything significant there, let's now shift our focus to gold. It serves as a reminder that the surge in gold is not limited to retail sales. Gold is also about official sector behavior, trust, and policy. And it's not a hearsay, the official sector angle. Significant purchases have been made by central banks in recent years, and the pattern has been consistent enough to appear frequently in official summaries and industry reporting. Because central banks don't purchase gold for a weekend trade, that is significant. As a strategic asset, they purchase it. The rival script now attempts to capitalize on a well-known investor statement that gold is useless. Furthermore, I'm not here to dispute that statement. This is the main point. The usefulness of gold is not that it can be used as a screwdriver. The fact that no one else is liable for it makes it useful. It's a resource that doesn't require repayment from another party, and the no one else's liability aspect appears much less absurd when governments maintain chronic deficits, interest rates increase, and debt servicing begins to supplant other spending. This is where new data is important because recent budget forecast summaries indicate that interest spending in the U.S. is expected to reach historically high levels in relation to the GDP and eventually take up a larger portion of income. Now, if you're thinking, well, that means hyperinflation tomorrow, pump the brakes. It doesn't necessarily follow that a nation can continue to have a large debt load for a long period. However, it increases the likelihood of policies that subtly cut real yields, promote financial repression, or depend in part on inflation. And in those situations, particularly when markets are erratic, gold and silver often behave differently than people anticipate. Let's now discuss the gold wild option story, which is another topic that quickly evokes strong emotions in people. The headlines will seem to indicate that someone is placing a wager on astronomically high pricing. Additionally, screenshots of fair outcall spreads that appear to show a whale forecasting that gold will reach the moon will be displayed. Perhaps, it might also be a hedge. Alternatively, it might be an organized role connected to tangible inventory. Or perhaps it's a fund that uses options to limit upside risk while cutting expenses. The key issue is that options positioning and conviction are not the same thing. Frequently, it's risk management. Unusual options flow can therefore serve as a hint, but don't base your entire perspective on a single options print. Let's return to silver now, as this is where the emotional whiplash is most severe. Silver fluctuates similarly to a smaller market that is influenced by major participants. Both overshooting and undershooting are possible. In a single week, it may make you feel smart and then foolish again. I want to give you a useful framework at this point. You should mentally maintain the 3 lanes distinct. Paper placement is lane 1. Options, margin, leverage, forced liquidations, and futures. Physical flow, actual availability, withdrawals, inventories, premiums, and deliveries make up lane 2. Lane 3 includes central bank activity, deficits, rates, the dollar, and geopolitics. When the driver swerves, most people panic because they mash all 3 lanes together. Avoid doing that. Lane 1 is if silver drops sharply following a margin hike. It is important to pay attention to the lane 2 indication if physical premiums increase while the price of paper decreases. Lane 3 is if gold is calmly strong while bond yields are fluctuating and stocks are trembling. The cliffhanger phase is about to begin. What occurs if lane 2 remains tight and lane 3 remains supportive while lane 1 is pressing liquidation? At that point, you may experience a dip that appears to be the end but is actually the reload. Though not assured, it is feasible. The narrative keeps faltering when people insist on treating a week's worth of price activity as a complete thesis, which is why this rally is ended. The competing script goes there, but I want to talk about the de-dollarization perspective now. It's a legitimate topic, but it's also simple to make into fan fiction. Indeed, over extended periods of time, a few significant nations have decreased their holdings of U.S. government debt. Indeed, gold has been building up in official reserves across the globe, and official records of holdings and flows do reflect this. However, that does not imply that the dollar will disappear on Tuesday of next week. The dollar system is unavoidable. It is supported not only by feelings, but also by markets, liquidity, and infrastructure. Thus, the dollar is finished rather than a binary. In my opinion, it represents a slow change in risk management. It is a hedge to have more gold as a reserve asset. A hedge is less exposure to long-term debt. A hedge is increased regional trade and settlement. The revolution won't happen overnight. Risk managers are carrying out their duties, and you don't have to go all doomsday if that's the direction. It implies that you ought to comprehend why the topics of gold and silver are constantly brought up. Since the competitor script promotes the notion that purchasing tiny explorers is the only way to obtain torque, let's now discuss junior miners. That might be accurate. Since it is a leveraged bet, a small mining company can move multiples faster than the metal. In essence, it is a call option with additional geology, finance, jurisdiction, and management risks. Thus, keep your eyes open if you're considering that lane. Don't buy a drill rig just because someone says it's turning. Find out how much money they have. How frequently are they diluted? Are they selling a dream, or do they actually have a route to a resource? What is the risk of jurisdiction? And do you accept that even good ideas can be short-lived and destroyed? because if you buy the wrong car at the wrong time, you can be right about the metal and still lose money in juniors. Since the goal of this channel is to help you maintain your composure when the market tries to shake you out, I want to return the discussion to you now. If you are successful, tell others about it in the comments section to keep them inspired. I also want to ask you a question that I really want answered. Do you believe that physical tightness or the unwinding of paper positioning will drive the next big move in silver? And a second, because this is also important, do you view a brutal pullback as an opportunity to reevaluate and possibly add, or as a warning? Where does that leave us at this moment? It leaves us in a market where narratives are quickly turned into weapons, margin changes are real, and volatility is real. China is left as a possible bottleneck story, not because of a single chart, but rather because supply chain flexibility and trade regulations can alter in ways that affect the physical market first. The only thing left for us to observe, but not misinterpret, is the COMEX delivery chatter. Looking for consistent stress signals rather than just a single large number that is repeated on a meme is the proper way to watch it. When fiscal math becomes ugly and official demand remains, it leaves us with gold as the uninteresting anchor that subtly gains. We are left with a world that is electrifying more quickly than it has in a long time, where government analysis and official U.S. energy forecasts openly discuss growing demand linked to data centers and new AI loads. No, I won't tell you that silver only gets better from here. It's not serious. However, I will tell you that you must stop thinking in one-lane stories if you wish to comprehend this market. The drop can occasionally be a margin mechanism. The pop can occasionally be a physical bid. Occasionally, the entire situation is a macro repricing. Occasionally, all three occur simultaneously. This is what I'm going to watch next, and I hope you will too. Do premiums decline or remain high when China fully reopens and regular liquidity resumes? Do the reclassifications and withdrawals in the warehouse reports appear to be typical housekeeping, or do they validate stress? After the shakeout is complete, does implied volatility continue to be high, or does it drop? Does the market continue to rely on the reserve asset narrative, as evidenced by the strength of gold's holdings even on risk-off days? You're thinking rather than just reacting if you're keeping track of those questions. And that's the main idea. Please hit subscribe if this breakdown was helpful, and remember to leave a comment for future Ledger Anna so I know you watched all the way through. Okay, that concludes today. Remain calm, maintain your curiosity, and keep in mind that this is instructional material based on current market developments and publicly accessible data. It is not a recommendation to buy or sell anything, nor is it personal financial advice. Make your own choices, control your own risk,